I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets. And that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand. And demand is just, going off the scale with photovoltaic cells and all the rest of it. So silver is it's being driven, if you like, by industrial means. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible.
Veteran monetary analyst Alasdair Macleod outlines how today's silver market is facing one of the most potent global squeezes in modern history. Years of structural undersupply are finally colliding with a wave of accelerating industrial demand, especially from photovoltaic manufacturing, where silver is essential and non-substitutable. Macleod explains that China, once the key arbitrage source that helped balance Western shortages, is now entirely out of the export market, facing its own internal squeeze. With both East and West competing for limited physical metal, the price is no longer responding to speculative flows but to real-world scarcity. As spot inches toward the upper 50s dollars, the psychological barrier of $60 becomes almost irrelevant. In a market defined by physical tightness rather than sentiment, incremental steps to $70, $80, $90, and even $100 emerge not as wild forecasts, but as logical extensions of a broken supply-demand structure. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets. And that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand. And demand is just, going off the scale with photovoltaic cells and all the rest of it. So silver it's being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be. But at the end of the day, you can't resist a bull market in anything. When you see something going up, you might ignore it for a bit. But then there comes a point where you can ignore it no more, and you've got to go and buy some. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible. No, it was a stand for delivery. Basically, someone bought the December futures. It's all on the December futures. And instead of closing the thing out and rolling it into the next one, which is normal practice, if you like, they said, right, come on, we want that stuff. Deliver. As they have the option to do. This is an extraordinary thing. It doesn't necessarily leave the CME warehouses, but the point is that the ownership changes and it goes into firm hands. It's no longer available as liquidity in the market, being registered for delivery. Comes out, that's it, tough. And in London, of course, there's no liquidity at all, which is why there's been that backwardation. And I think the reason that the backwardation has gone is principally because we're rolling over into the March contract now. So there is a time factor in there, if you like. I haven't actually done the calculation to see exactly what it sort of rather indicates in terms of, whether this is a backwardation once you allow for financing costs and all the rest of it. But, I think the point is that there are huge shortages everywhere. Whether it's COMEX or London is immaterial. And incidentally, also, the shortages seem to be in Shanghai because the silver stocks have gone down. I mean, they're under 600 tons now, which is seen rather as a Rubicon figure. I mean, if you go underneath there, you've got problems. It's also worth noting that from January the 1st, China is banning the export of silver. Now, that's interesting because China has been, in my view, the swing factor in controlling prices in the West until very, very recent. So if they're withdrawing from the market completely, there is no lid on silver, none whatsoever. I mean, in China, it could be a speculator, I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market. Let's take the first one, actually the last one you mentioned, the spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it and, premiums and things, we can trade this. They're not doing it because there isn't the liquidity to do it. Because, if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied direct to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, not short it, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on. Which is one reason why I'm not keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. I mean, if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market.
Alasdair Macleod outlines how the silver market has slipped into a full-scale global squeeze, one driven not by speculation but by years of structural undersupply. China, once the key balancing force for Western shortages, has completely exited the arbitrage flow and is now facing its own declining stockpiles, with Shanghai inventories falling below 600 tons. At the same time, Beijing's upcoming ban on silver exports removes the last primary release valve from the global system. Industrial demand, from photovoltaics to advanced manufacturing, continues to surge, while futures market deliveries are increasingly being taken into firm hands rather than rolled forward. With liquidity evaporating across COMEX, London, and Asia, the market is finally adjusting to a reality in which physical metal is scarce and price suppression games no longer work. Let's get into the interview.
The other thing, of course, I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble. What that means is, sorry, I interrupted you.
No, I was just going to say I have the gold chart up, but yeah, continue. Go ahead.
Yeah. I mean, the point to understand is that over long periods of time, the purchasing power of gold is stable. Things change and so on and so forth, but it's been the case really going all the way back in history. I mean, the thing about gold is that the above ground stocks have tended to increase more or less in line with the global human population. I mean, we've got records that go back, quite a lot of it estimates, but, sensible estimates. And we can see that relationship. And not only that, it is embodied in all our laws that it is real money, final settlement, expunging all counterparty risk. That's the important point. And it doesn't matter what the US Treasury says, whether it's a pet rock or whatever. I mean, they're just promoting their own fiat currency instead. But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money and has been and will continue to be through millennia. So when we see the gold price rise from, in 1971, from $35 to currently $4,234 as we speak, I mean, that's not gold rising. That's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled. As we know, the best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold. Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, they think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no. That's wrong. The purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than the assets to back them in terms of value. They just don't choose not to mark things mark to market.
The discussion turns to gold as a signal that the global fiat system is entering its most fragile phase in decades. For centuries, gold's purchasing power has remained remarkably stable, rising not because it becomes more valuable, but because currencies lose credibility. Today's surge from $35 in 1971 to over $4,200 reflects a structural breakdown in trust, not a speculative frenzy. Gold's legal and historical role as final settlement money stands in sharp contrast to the weakening credit foundations of modern central banks, whose liabilities now exceed the real value of their assets. While mainstream economists still expect inflation pressures to ease by 2026, the market's message is the opposite. Declining confidence in credit will force consumer prices higher. Gold is simply revealing the truth that official statistics obscure. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.